So, Michael, I would like to start this interview by asking about quantitative strategies and to what extent you think that it's very suited for crypto markets and for crypto assets. And how does that compare to traditional assets when we talk about quant strategies?
Yep, great. It's a great question, and thank you for having me here. So digital assets is a developing market. It's very nascent in its growth, if you will. So with that, we have a huge number of retail trades going through the system. And that allows quantitative models to be able to find different types of alpha and different types of returns within the system. If we look at traditional markets, we have probably about a century of different models looking to find P&L within the system. Within digital assets, we're still very early. We're sort of 10, 15 years of the evolution. And so what we see is a huge opportunity for these models to be able to be applied to the space and find risk-adjusted returns.
So obviously, we need these models to generate risk-adjusted returns. But what about risk management, Michael? To what extent the nascent nature of digital assets makes it difficult from a risk management perspective when it comes to crypto quant trading?
Yeah, again, good question, Henry. So I'd say there's no free lunch. So with higher returns comes higher risk. And the best way to think about this is that you have sort of this young infrastructure, and with that becomes more risk. And so we've seen hack risk with the sort of different cyber types of weakness. We've seen all kinds of volatility in the space. And so what we do at our firm is look at it in two different ways. We look at counterparty risk management, and the best way to do that is diversification, and really looking to some of the guests that you've had on this show, as well as other industry leaders, in partnering with best players in the space. And then from a portfolio management perspective, really trying to apply traditional finance application and how you would look at a high volatility asset and dampen some of the huge swings.
So when we talk about machine learning and AI, to what extent are they playing a big role in quant strategies?
So I say they play a big role in everything today. I'm the CEO of the firm, and I use ChatGPT every day.
Wow.
I recently sat with our senior executive team, and we looked at sort of the evolution of how we use quantitative trading within AI. And our understanding, even the last 3 months, is that the ability for AI to help us to both digest data and come up with models has been a huge stepstone. So we envision AI to be a major tool in the toolbox of what our quants use, and it will allow us to do more with less. The key here with AI is to understand the infrastructure. And for many years, we've heard about data being the new gold. I think that is now really true. And within digital assets, it's understanding what data is important.
So, Michael, based on all this, I want to talk about some of the investor base as well. I mean, you spent your career working with some of the biggest hedge funds and allocators in the world. What do you think is needed for these large? First, are these large allocators coming into crypto? And if yes, to what extent? And if no, what do you think is needed for them to actually enter the space more actively?
Yeah, thank you. So I think it's still very early in the evolution. There's if you look at a prior cycle within digital assets, there's a lot of allocations into venture capital firms. So we now have 4 or 5 huge venture firms that are very well known in the system. We've yet to have the same large liquid funds, and there's probably 10 or 12 funds of size globally, which if you look at the hedge fund world, there's thousands, right? So it's a very small universe. In order to get the allocators comfortable to allocate, you need to have funds that have the pedigree as well as the team to be able to ensure that their money is safe. The concept of fiduciary responsibility is paramount for these firms, and most crypto funds today are more focused on the returns and less on the infrastructure build. So I think bringing in executives that have 20, 30 years of traditional finance to build a compliance regime, to build out a risk protocol is very important. I think we're on that journey now, and we're about to take the jump-off mark. And so I'm very confident over the next 2 to 3 years that we'll see a lot of inflow into the space as well as some large firms develop.
So, Michael, one last question. When you look at what happened in the crypto industry over the past years, of course, a lot has happened. It's enough that we've seen enough institutional investors pour in money into this landscape and to this industry. To what extent did that impact how the crypto market structure and trading system have evolved as well?
Yeah, that's a good question. So I think, digital assets is unique in that it's a retail market that's brought in institutional versus the outside, right? We're now seeing more and more of the institutional flows become market making. And I think there was a pause with some of that, and some of the firms that were doing this essentially didn't have the best risk management protocols, so they got moved out. And the new players are better suited.
It's been very exciting ahead, huh?
Yes.
Very exciting times.
Yes.
That was Michael Ashby, the CEO of ALGOQUANT. Michael, thanks for being with us today on Crypto Weekly.
Thank you, Michael.
Are your children prepared for the future of money? Order Decoding Crypto with Henri and Hodler, the #1 new release kids book on Amazon.